We've had multiple conversations with a $60 billion investment platform, and it came from a ranking member of their team with a gray silhouetted Twitter profile because they saw something that we were tweeting about. I picked the one out of the three to not become a unicorn. So great picking on my part. With all of those in mind, like we ran the math 100 different ways to Sunday, and every single time it made the most economic sense to build a fund. 100 million net asset value of the fund, the equity being worth 100 million. I went from making 500 to basically zero for 2 years in a row now, and it's probably going to be zero for another year or two. I'm reinvesting in hiring the team and building this out.
What are you doing right now? What the heck is your business?
Yeah, so I run a real estate fund. So we buy single family homes in really high-end school districts, and then we rent them on long-term leases to families that want to be there in a really good school district.
I think that was the best explanation I've ever had somebody give. It was short, succinct, not a lot of wasted breath. It's amazing. Your thesis is to buy homes in good school districts and then rent them long-term to people with families.
Exactly right.
This wasn't always what you did. What did you do before the fund? Like, how long has the fund been around?
Yes, the fund's been around for about a year or so. But I was doing this personally with my own money for about 3-4 years before that. So I started my career in consulting, both for a big consulting firm, and then I was also doing it independently. And then was basically taking the dollars I was making on that and moving them over to the real estate so I could buy some homes. After doing that for a couple of years, it's like, okay, like there's enough meat on the bone here. I can leave the consulting and do the real estate full time.
Okay, so before the fund, you were just doing consulting full time?
That's right.
Now, was it your consulting or was it like, hey, I work for BCG or Bain?
It was both. So I started my career at BCG, worked at BCG for a couple of years, left, actually joined a venture-backed startup and was employee like 40, 50, doing strategy and operations for them. I had a lot of time on my hands. So I started doing some consulting on the side because I knew how to do it. And then that kind of quickly compounded to the point where I left the startup to do my own consulting for a couple of years.
How did you actually find the work?
A couple of different things. Mostly I used a platform called Catalant. I think of it as like Upwork, but a higher market, meaning the clients are Fortune 500s, they're mega private equity funds, places like that. So I would go on there and there'd be major private equity firms looking for a consultant to do some work. And then I would apply for that work. Similarly to Upwork, just different clientele.
So a lot of times people think about entrepreneurship as like, quit my job, bought a business, or quit my job, started a company from scratch. You did it in a way that is the way that I think is the safest way to get into entrepreneurship. You work, you get some corporate experience, you build a company around consulting, and then it's tech, right? Land and expand. You've heard that phrase, like you land in one thing, you expand. And then you went from consulting and you built an actual business. Was that thoughtful? Was that intentional? Or was it like, it just kind of happened because you're putting one foot in front of the other?
It was a little bit of both. At the time, it was like, hey, I know how to do the consulting work. This is easy stuff. Once I have the client, I know how to go from idea to delivering something that clients happy with. Like I just kind of fell into doing that. But to your point, like you learn pretty easily. Like it's like business training wheels. Like, hey, I'm doing something I already know how to do. Now I need to learn how to like price work, how to do the legal, how to do the insurance, how to do AP, how to do AR, how to do those kind of basic things on top of something I already know how to do. And then you can then get those business training wheels, do something a little bit harder of like, hey, I still have those basic business foundations that I've now learned, but now I'm doing something during the day-to-day that I don't know as well as, say, I used to on the consulting side of things.
What was the idea behind getting into consulting and doing Catalant? Was it to control your time, or was it like, I want to be an entrepreneur and this is the next logical step?
It was neither, actually. So I left BCG knowing I wanted to do venture-backed startups. I was like, I want to work at a venture-backed startup. I had 3 offers when I left BCG. I picked the one out of the 3 to not become a unicorn. So great picking on my part.
Good for you.
Yeah. At its core, like I needed money. I was going to buy a ring to propose to my now wife. So that's why I started doing consulting work. It's like, yeah, like, this is a good way to make some money to go buy a ring. And then it got to the point of like, hey, like actually I'm making a good amount of money. I'm just going to keep doing this because I can now go buy some real estate with it.
So you went to Wharton. I can tell because you're wearing a Wharton sweater.
Yeah.
How old are you?
I'm 30.
Okay. So you went to Wharton, you came out of school, you work in consulting. I've always heard consultants make really good money. Would you mind sharing, how much money did you make the last year you were a consultant?
So at BCG, when I started, they bumped it up since then. It was 80 grand base salary out of school. And then with bonus and everything, I think it was like 96 total year 1. Year 2 was a little bit more than that. This was 2017. So there's been a couple pay raises since then, but it was basically about 100 right out of school. And then independently, that was between like 450 and 550 a year.
Really?
Mm-hmm.
So it was a big jump when you went from BCG.
It was a very big jump. It was a material jump to the point where it was a pretty significant lifestyle change, in that I've got 2 kids, a third on the way. We were able to like afford childcare, and we were able to start buying investment property and do things like that.
That's incredible.
So it was a big jump.
Okay. Year 1 out of school, 100 grand. Year 2 out of school, call it 110 grand, about the same. Whatever.
Yeah, 115, 110.
Year 3, what were you making year 3?
Year 3 was, I was at the startup. So I think I made like 65 at the startup. And then independently on top of that, I did like 503, 504. It was like a smidge over 500.
Oh my gosh.
So like year 3 was like a life-changing year, for lack of a better way to describe it.
How many years ago was this? 2020?
That was 2018, 2019.
Okay. So you're like 26 making 500 grand a year?
Yeah, I was like, I have 24, 25, because I had my eldest, my son. And when I was 25, I was over 500 that year.
That's incredible, man.
It was a really kind of great nuts situation that like I completely kind of fell into.
A year ago, I think, I don't remember. Somehow either you posted about it or you messaged me when I was asking about Catalant. I signed up, I went through the onboarding process, and
Nice.
I looked at it. The hard part was, like, at least from my perspective, there were no jobs for me to bid on that fit my skill set, because I have like home health and hospice leadership, and a lot of them were project based that were not that. What was your skill set? Like, what was the work that you followed into Catalan?
Yeah. So for me, it was mostly functional versus industry work. So I did a lot of post-acquisition private equity work. Typically first like 6 months post-acquisition, there'd be a CTO, chief transformation officer. And I was basically like a chief of staff, like lieutenant to the CTO, where they had, hey, we bought this company. We had 10 reasons why we think we're going to make it better. And like, we just need people to start knocking stuff off this list and getting stuff done for us.
Were you doing one project at a time, or was it like 4 or 5 projects that you took on?
Yeah. So that was the challenge. So I was typically doing 2 to 3 projects at a time. Back then, Catalan didn't have great controls of like how busy people were. And I was winning a lot of work. So, and they were sending more work my way. I just kept on saying yes to it. But I was doing 2 to 3 full-time projects at a time. So it was a great earning year, but it was not a light work year, to say the least, when that year 3 that we're talking about.
So each one of the projects was full-time work?
It was full-time work.
When you won one of these projects, they're probably like a range, but typically speaking, how long were they and how much did they pay?
Yeah, projects range. The shortest was about 3 weeks, which that was pre-acquisition private equity work. We were helping out on the due diligence. And then post-acquisition, longest was about a year. Range, they did it off of daily rates. And your daily rate depended on a variety of different things. The biggest one being length of project. Longer the project, the less rate, because you've got more kind of security in that.
Sure.
Longer term projects like 1,500 a day. If you're doing like a 3-week diligence, you could get up to like 2,250 to 2,500 a day.
Jeez Louise. How hard was it to get work at that time on Catalant?
It's really hard to get started. The challenge with Catalant is they don't let everybody on the platform. They actually reject a lot of people who apply for it. So everybody who's on the platform has game, for lack of a better way to describe it. And when you're pitching on these projects, you've got 30 people who apply. You've got industry experts, you got ex-McKinsey people, you got ex-Goldman people, ex-Blackstone people. Like, you've got really high caliber competition. It's hard to win your first couple projects. Once you do, though, it's kind of like Uber in the early days, where it's a closed-end system where you have to review each other. Once you win a couple projects, you get 5-star reviews. You suddenly start becoming like one of few people that have a track record that's demonstrable on the Catalan platform. It becomes easier and easier to win each successive project from there.
Well, next month, it'll be a year since I started this podcast. I've had over 100 interviews. It's been a ton of fun, but I promised my wife at some point I would decide whether or not this was going to be a business or we would just continue to pay for it out of our pocket. And I'm exploring monetization, to be honest with you. There's not a ton of costs, but I do want to figure out a way to cover the editing and the packaging and the promotion costs of putting this podcast together. So I am looking for sponsors. I don't know what that looks like. If you've enjoyed this podcast and you've ever found some value and you want to sponsor, reach out to me, nick@cofounders.com, and let's get back into it. Do you still do any Catalan work?
I can't.
No.
Not with the fund. I am not allowed actually under our fund documents.
Okay. Good to know. Good to know. This Catalant thing is just like shocking to me. So that they essentially have large companies come on and say, this is the project work that I need.
Mhm.
And then on the other, so that's like the supply side. And then on the demands, or however you want to say it, then on the supply side, you have people like you who are like, yep, I'm an industry expert, or I can do X, Y, and Z. What functional tasks were you actually doing? Were you like running Excel models, or were you actually running a team that was implementing the new CRM or the new HRIS systems?
Honestly, all across the board. It depended on, most of the work was that post acquisition value creation work. And it was a lot of like, what we just need somebody like smart to jump in and just like figure stuff out and get stuff going on. So sometimes it was a project where there were new product introduction, MPI process, where the product is a year delayed and they need to figure out why, need somebody to start removing blockers so they can get it done. Sometimes it's like, hey, we're moving our supply chain optimization software and we need someone to help make sure that we don't lose.
So it wasn't even like, oh, I have a technical expertise. I'm a coder, I'm a biller, or whatever. It was just, hey, we need somebody who kind of understands this world to do these functions for us.
Exactly right. Catalan uses the word athlete to describe it, of like, we just want somebody smart that like, we think we can introduce a problem to them. They can put their arms around it for an hour and like be dangerous enough to like go do an Excel model and be like, hey, look, like you're trying to introduce this new product and all of the work has stopped at this one specific person. This one specific person is not getting anything done and not advancing it. Like Sean's going to go back and now tell the CTO like, hey, Joe Schmo in accounting is who you need to talk to because it seems like everything is stopping once it reached Joe Schmo. And they're like, okay, great. Tomorrow I need you to go figure out like, we need to renegotiate these 30 vendor contracts, like put a plan together and a proposal together for how we're going to go run an RFP process for all of these guys because we know we're being overcharged by at least half of these guys. That's sort of like athlete work.
Bro, I'm going to go look at Catalant. I'm looking at Catalant tonight. I didn't even look at those types of projects because I'm like, they're probably looking for somebody who's like, this is the exact discounted cash flow model we want built. And we want to make sure that you understand, the Pareto principle when applying this to the economy. It's like, I don't want to figure that stuff out. But if that's it,
yeah.
I could have been working all this time. Okay. So you're making 500 grand a year. And I saw that like you built a Twitter audience. You started posting on Twitter about consulting in particular. So when I saw that you started this fund, buying real estate in good school districts and renting it out to people, it's like, okay, that's out of left field. How the freak did you make that transition?
Yeah. So real estate's always been the thing for me. So I moved 22 times before I went to college. I bounced around a ton growing up and that got me interested in real estate. Like finding a place to live was this thing we were doing every 8-9 months. And my mom was a teacher growing up. So I was also like pretty tuned into like, hey, like everywhere we live, like there's a really good school district and people tend to try to prioritize living there. So I've had this idea for what is Scholastic for a long time now. And I always planned to buy homes under that thesis. I just didn't expect to have the disposable income that I had at 25 to be able to start buying $500,000 houses as rentals. But I did. So I started buying homes and built a portfolio larger than I expected to. And to your point on Twitter, like I used Twitter kind of like a public Slack channel during COVID, where I was just kind of like publicly posting what I was thinking about and what I was doing. And it got to the point where I was sharing about what I was doing on the real estate side. People were reaching out like, hey, like next time you buy one of these, can I kick some money in? It's like, okay, like there's interest in this thesis that I'm doing. And I've now done this for a couple of years. I feel like there's pretty good meat on the bone at this point. I feel confident in what the actual thesis is. Maybe it's time to start bringing in outside capital to turn this into a fund. I thought that was going to happen 10, 15, 20 years down the line from what it is.
So why did you decide to start doing the fund? Because it sounds like you were funneling cash into these single family homes and renting them out. I have a thing against funds. I'm just like, I don't want to raise money because then I give up control and then I have people to answer to. And if I fail, I let people down, which is a big deal to me. What was the tipping point? Like, why did you decide, hey, I need to raise a fund?
It's a great question. And I agree with you on the letting people down component to it. It's not easy. For the fund, it honestly came down to the investment makes more sense the more homes that we can buy for a variety of reasons. Like we can charge a more premium rental price the more homes we have. We can service the homes at a better, lower cost. The more homes we have, we can potentially sell the portfolio as a portfolio, the more homes we have. And with all of those in mind, like we ran the math 100 different ways to Sunday. And every single time it made the most economic sense to build a fund. And if we were going to accept, call it any outside dollars, even if a good friend wanted to kick in 50 grand to the fund, I didn't feel right in doing it at a small scale of just say 50 grand, because I know it would be a suboptimal outcome. The best financial outcome would be to make it bigger than that and make it a true fund model.
When did you launch the fund?
We started putting the fund together about 2.5 years ago. We formally started fundraising about 1.5 years ago. And then we formally started buying homes about 8 months ago.
And how much did you raise?
We've raised about 5.5 million to date. We've got another, call it 40 in the hopper right now that is likely to come through over the next year.
40 million?
Correct.
Jeez, man. Oh my gosh. Was that the plan? Were you like, yeah, we're going to go raise $50 million? Or was it like, well, let's start with 5?
The plan was to start with five. We're a rolling fund model. So one thing about our thesis, buying homes in good school districts, our tenants are families that move in the summer between school years. So buying homes right now in January doesn't make sense because there aren't tenants looking for homes. We're basically on a yearly schedule of we raise in the fall, winter, and then we go buy homes in the summer and then kind of repeat that process. So year one, we did the 5 million. We bought 21 homes with it. That was our, call it, first cycle. And now we're gearing up for cycle number 2 this upcoming year, which we can go bigger now that we've got a team in place now. We've got really good vendors. We've got a really good process and system built out. So now we can do a little bit bigger.
So if I was your wife and I was like, wait a second, Sean, we're making 500 grand a year right now.
Mm-hmm.
You want to go raise a fund? I'm assuming, I don't know, you're not paying yourself 500 grand a year out of the fund. How was that conversation?
Yes. I have an exceptionally supportive wife. I went from making 500 to basically 0 for 2 years in a row now. And it's probably going to be 0 for another year or 2 down the line, because I'm reinvesting in hiring the team and building this out. Yeah, I have an extremely supportive wife who makes a good salary on her own that allows us to, for lack of better words, keep the lights on here.
How does the fund work? So you've raised $5 million, but you're not paying yourself a salary. Are each one of the investments like their own SPV, or is it all pooled together? Like, can you talk about how it functionally works?
Yep, for sure. So it's all pooled together, and we basically function like a private REIT. So investors buy into it and they get monthly distributions out. We pay distributions out the third Friday of every month from the profit from the previous month of operating. That's basically the dividend for the investors. And then on the actual equity side, our accountants, the fund administration vendor, every quarter revalues the fund. So every quarter, the investors get a statement that said, hey, you put in 250 grand, it's now worth 290, and you were paid out 12 grand in distributions over the past quarter. That's basically how it works at its core. On our side, we have a 1.5% management fee, and then we get 15% of the proceeds. So like the old 2 and 20 model, we're 1.5 and 15.
And 15.
Yeah, exactly. So the 1.5%, that is for fund fees. Some funds can use that as like a profit center. For us, like we use that to build our team because we want to grow the fund. We want to make sure we're doing it right. So me not paying myself is me hiring a team basically in lieu of paying myself.
So does that mean if you've raised $5 million every single year, you get $75,000 essentially as the 1.5%? But then you're also getting 15% of the distributions.
15% of the distributions, correct.
Sorry, did you say 50 or 15?
15. Oh,
Okay,
50
yeah,
would be 50 would be a lot.
Dang. All right. And the way like this typically work, at least for dumb people like me, is you'll have this GP LP model where the LPs are the limited partners. Typically they're the ones contributing capital. And then you got the GPs, the general partners, who are operating the business. And so I think what you're saying is 85% of the fund equity essentially is owned by the LPs, 15% is owned by the GPs, you and your partner.
That's right. That's exactly right.
Is there a preferred return to the LPs? Like, do they have a pref?
We have two different unit models. One has a preferred return. It's got an 8% pref and then a split above that. And then we also have a model that doesn't have a split. The math is almost exactly the same between the two. So we have them both as options. We have some LPs who prefer one versus the other.
What do you prefer?
I'm indifferent. The math is basically the same for us. It really depends on how LPs are thinking about it and what they're looking for their investment.
So if you get to that 40 million and you've got $45 million under management, then you're at a spot where you're doing, what is that, 450, 700, call it, actually more than that, 750 in management fees. Where does that money go? Who are you hiring besides just you? And is it you and a partner, or how many, are there multiple partners?
Yeah, so we have, the team's actually quite large. So it's myself and my actual partner in the business, Twitter gentleman, as actually, and then we've got 6 advisors who each have a percent of the business. Gentleman from Blackstone, gentleman from Tricon, gentleman from a big single family fund in Louisville.
They've got a percentage of that GP, that 15%.
Correct.
Okay.
That's exactly right. That's called the advisory team. On the day-to-day, it's myself. I've got a operations manager and I've got an asset manager. We're hiring a controller and an accountant right now. But to your point on that 750, that 750 goes to hiring a leadership team, and in a fund that's not cheap. So for example, for us, we'll need a CFO. CFO is about 400 a year. We need a VP of IR. They'll be around 3 to 350. And then we need a VP of asset management. They're about 300 as well.
All right, now's the part of the show where I feel the most uncomfortable, but my therapist says I need to face my fears. So here we are. I've started a newsletter and I want you to subscribe. And what you're going to get every single week are the aggregated conversations from that week that I have on this podcast with an overview of what their business actually looks like. I'm also going to throw in a review of 1 or 2 businesses that are listed for sale. I'll give you my opinion on whether or not the EBITDA multiple is good, or there's customer concentration, or there's red flags or green flags. And then lastly, I'm going to give you one piece of actionable advice every single week on how to buy your first business. So click the link below, subscribe to my newsletter, and let's get back into the show. It's not like you can just go, I'm going to get a fractional CFO, or I'm going to go overseas and hire, talent in LATAM. These are highly specialized, specific positions. Like the CFO of a fund is very specific because there are regulatory requirements for the way the fund is supposed to operate, disclose, report, all of those things. Is that why they cost so much?
That's exactly right. We have a lot. I mean, we're an SEC regulated industry. We have a lot of rules and requirements that we have to follow. My team right now is based in Latin America, and they're fantastic, and they are always going to be a member of the team. But when I hire a leadership team, when I hire a CFO, I need somebody who is stateside. They are probably chartered. They have a significant amount of experience with the SEC. They're used to working with institutional investors who are deploying large amounts of capital and have a certain expectation of experience dealing with SEC rules and regulations.
I'm just doing the math, right? I'm like, cool. Sean goes from making $500,000 a year, amazing, to making no money per year. And even if you raise the 40 million and you're at 45 million, you're still $750,000 that's just going to pay administrative fees.
Yep.
Right. And then you have other partners who are a part of the GP. I don't see a world where in the near future, Sean's making $500,000 a year.
Yeah.
What is the thesis with this fund? Is it to operate it for a couple of years and sell and have a big liquidity event? And what size are you aiming for?
Yeah. So where the fund makes sense is as we continue to grow and get bigger. The sweet spot for us is getting over, but once we get over about 100 million, then things get more and more interesting from a financial perspective for myself and the remainder of the partners. For us, we're going to continue to add homes into the fund and grow. We may sell down the line. We've been very intentional about choosing homes that we can sell, about choosing debt that we can sell. We're basically building a portfolio and a roll-up that we could sell to a Blackstone or an Invitation down the line.
And when you say 100 million, is that 100 million raised, or is that 100 million value of the fund?
100 million NAV, so 100 million net asset value of the fund. So the equity being worth 100 million in the fund.
Buying $100 million worth of single family homes in good school districts.
Mm-hmm.
Let's just say that every single home is $1 million. That's 100 homes that you have to buy. That's a lot of homes to go through and buy. And even if you bought all those homes over the next 5 years, it's still 20 homes a year. And essentially this short window of time of the summer or whatever.
Yep.
How do you, are you buying them onesie twosies, or are these coming up in portfolio deals?
We are buying them onesie twosies. These homes aren't available in packages, which is why why us creating a package is of value to somebody, because they can then pick it up from us. But to your point, like this is an exceptionally ops heavy business, to my knowledge, more so than any other form of real estate, and why that ops PE background is extremely useful. I mean, at its core, I need to basically be building my data room as I go along with everything that we're doing. So for example, like every time we buy a home, I need make, model, serial number, year for every single piece of capital equipment in every single house. Because somebody at Blackstone is going to be looking at this data room in a decade, hopefully. Like they need to have a tape that says, hey, here are all the ovens in all of the houses, how old they are, how many years of useful life they have on them. Like I need to be like, hey, you want to know how the shape of the portfolio? Like here is a detailed log of every single time we sent out a service tech to all of our properties over the past decade. They're in pretty good shape. You can see why. Like we've taken good care of them. Give us the right price.
How many homes do you currently have under management?
We've got 21 right now. We're probably going to pick up another 30 to 40 this summer.
So your core business is finding and buying these homes. What about the property management? Do you do that, or is it strictly you find property managers in different locations?
We are involved on the asset management side. So we do have a property management partner that handles the actual day-to-day communication with the tenants. That being said, we're overlaid on top of that, and we have direct integrations to all of their software. So
do you own that business though, or are they a standalone vendor?
It's a third party. It's a third party that we work with. We have recordings to all of their phone calls with tenants. We have access to all of the data. So we overlay, but we don't actually do the.
Would you be allowed to start that business?
We could do it ourselves. There's a point at which it makes sense from a sales perspective to do that. That's probably around 200 homes. Before then, the economics are going to be really tough.
Makes sense. Why split your attention when you're strictly focused on buying good real estate? Are you focused on specific markets, or is it like anything that comes across your desk? How are you actually acquiring these assets?
Yeah, so we are focused on specific markets. We've got 37 zip codes that we track across 5 states in the upper Midwest. Minnesota, Wisconsin, Illinois, Indiana, and Michigan is where we target. And that's going back to like, hey, we're building this portfolio to sell. We've spoken with all of the big funds. We've said, hey, if we build this for you, where do you want to buy it? They all said independently, upper Midwest is where we'd want to buy it. So we're building it in a way that we can just drop it off to them.
There's something about Twitter that I've noticed is there's a couple things that it's really good for. It's really, really good for people who have a product that have built distribution, right? So if you have a certain number of followers, you have access to people, and it's about finding product market fit. It's like, okay, or product audience fit, I like to say. What product will fit my audience? And sometimes it's Nick Huber. He started somewhere and has, he's selling VAs to people, or it's courses, or it's whatever else. But something that I think is underrated is Twitter as a fundraising mechanism or a fundraising channel, because you've got all these people who have built trust with you. They understand you. They know who you are. And so when you say like, hey, I'm raising money to do X, Y, and Z, you have access to funds. Is my thesis correct? Are the majority of your funds coming from like Twitter connections, or are these outside of Twitter?
Twitter has played an outsized role. Not necessarily. Some of it is from people directly from Twitter who saw something like, oh, that's interesting. Or it's come from somebody on Twitter saw something and then sent it to their uncle who they thought would find it interesting, who then introduced it to a friend of theirs who ended up investing in Scholastic.
So maybe it was like good to get going, but it's not necessarily now the main feeder?
It's not the main feeder, but it's a big driver of, call it, initial interest, and a big driver of like vendors. We found a lot of vendors through Twitter. It's a good way that we've validated quite a few hypotheses and hires.
Would you have launched this if you hadn't had an audience on Twitter?
It would have been exponentially harder to do so, because this is.
But would you have launched it?
Honestly, I don't know if I could have afforded to.
Really?
And the reason why is we are an exceptionally legally complex fund. Just because our rolling fund structure is difficult. It just so happened that probably the best investment funds attorney in the country is on Twitter. And we met via Twitter, and he joined the fund to help do our legal work. Like, I don't think I could have paid the $150,000 out of pocket it would have cost to have set up our fund the way that we did.
That's another really good point about Twitter, is like, it's not just, I thought coming in, it was like deal flow. Oh, cool, I'll get on Twitter and there'll be deal flow, or, oh, cool, I'll have an audience. But it's the caliber of people that you meet who have, like, I don't know, some NFT as their profile picture, and it's Dragon Slayer 69420. And
Yep.
you, like, they never post about anything, but then all of a sudden you get a DM from them and they're like, hey, I run this division of Fidelity and I really liked what you said about X, Y, and Z. We should talk. And you're like, what the freak?
Yep.
It's crazy.
It's 100% true. And it's always like the NFT or like the gray profile with just some random username. We've had multiple conversations with a $60 billion investment platform about an investment from them to Scholastic. And it came from a ranking member of their team with a gray silhouetted Twitter profile reaching out because they saw something that we were tweeting about. Like it's a very underrated element of Twitter.
Dude, it is totally. I've always said, I feel like Twitter is what people hoped LinkedIn would be.
Yes.
Where you're making real connections with real people who have actual influence in the companies. I like LinkedIn, but man, the DMs are a freaking mess. And I've never met, personally, I'm biased. I just haven't made as good of connections on LinkedIn. There's just something about Twitter where these people go and hang out and they can be totally open. They don't have to be a VP of corporate ops that they are on LinkedIn. They can be Dragon Slayer 69420 and tweet whatever they want. And then if they do want to reach out to somebody, it's like, hey, by the way, I know I just posted about D's nuts, but I'm actually a fund manager with Blackstone. You're like, wait, what what? So funny, dude. It's so funny.
It's so funny. But it's just great. It's also people who don't take themselves too seriously. Like I feel like LinkedIn people are a little too buttoned up. Everyone on Twitter is like a genuinely good person for the most part.
It depends on which part of Twitter you are. I think
that's
SMB.
That's a great caveat.
Yes. SMB Twitter, real estate Twitter are amazing. You get outside of that, it's kind of a cesspool. Dude, politics Twitter, oh my gosh. Don't go viral and get politics Twitter involved. They will not like you.
That has happened a couple of times, and it's never a fun day or two when that happens.
It's never a fun day or two. You know what's cool too is like, because you've been public about it and because you tweet about it, your investors understand that that's just a part of the fund. It's like, hey, that's just the dynamic. And so you can keep doing it. Whereas if you would raise this fund and then you decided you wanted to start posting on Twitter, it gets a lot harder to do that because people are like, wait, whoa, Sean, I didn't invest with this. I don't like this thesis. I don't like you putting stuff out there. So I think that's actually a very helpful part of you having had experience on Twitter. Do you agree?
I think that's a great point. I think it would be really hard to do retroactively, but now it's a pretty core part of what we do. Like I send our investors their monthly update. We send a lot of data to our investors every month of what's going on in the portfolio. And then 2 weeks later, I basically send the exact same email with some edits of like the confidential stuff, like some edits out, but it's a very data heavy email that we send out publicly that is, call it 85% the same email that the investors are getting.
Dude, that's insane. All right. Last two questions. First question, have you deployed $5 million or you just raised it?
We have.
Okay. So you deployed $5 million. What is that currently generating on a yearly basis for dividends?
Yep. On the dividend side, it's about 5.5%. And for 99% of investors, that's 5.5 net of taxes because we also pass depreciation back to the investors on the K1. So it's like an 8 to 9 pre-tax.
Are you passing everything through to them?
Correct.
Okay. So you pass everything through to them. And then on top of that, well, I'm assuming actually you're probably paying property management fees pre-dividends. So any operational expenses?
Yes, that 5.5 is net of everything.
Okay. And then the houses that you're buying, are you going in and bidding above market? Like, are you going above asking? No, because that's the knock on a lot of these funds, right? It's like, oh, Blackstone's coming in, they're buying all the single family real estate, they're driving the prices up, they're paying over market, but you say no.
We won 55.1% of our offers this past summer. And so we win a little bit more than half the time we offer on a house. And we are almost always the lowest offer when we put the offer in. In most cases, because we buy in neighborhoods that are very high owner occupancy, we are the only investor buying the homes. But as a result of that, sellers have a much higher degree of confidence that we're able to close, get approved for financing, and actually not nickel and dime them on inspections. They tend to like working with us. The other element too is we don't have to take a buyer's agent fee. So the seller's agent can keep both sides of the commission. Seller's agents like working with us as well. So we win more than half the time with being the lowest offer.
That's awesome. Well, what's the name of your fund?
Scholastic Capital.
Scholastic Capital. Okay. Love it. This was awesome, man. Appreciate you coming on.
Thanks for having me.